Subscribe to our YouTube channel and press the bell icon to get the latest updates.
Hello everyone, this is Rahul Shah here, trying to make investing accessible and profitable for the average investor. Since this is my first YouTube video of the year, let me wish you a happy and a prosperous new year. May this year be filled with lots of health, wealth and happiness for all of you. Now I'm sure you would have come across hundreds of articles and videos with the top picks of 2022 as the central theme. This is an annual ritual for majority of stock market experts and nothing wrong with it as long as they clearly explain the rationale behind their picks. I'm going to take a slightly different approach, however. I believe that investing is as much about keeping poisonous stocks out of your portfolio as it is about investing in the next set of winners. Please remember Warren Buffett's 2 rules of investing. Rule number 1, do not lose money. And rule number 2, do not forget rule number 1. The idea here is to take care of the downside so that the upside takes care of itself. And this is precisely why every year around this time, I put together a list of 20 to 25 stocks, or maybe even more, where I decide not to recommend in any of my services for the entire year. I label these stocks as toxic or poisonous stocks and the ones capable of causing your portfolio a good deal of damage if you're not careful. Now, what are these stocks and how exactly did I arrive at these names? Let's answer the second question first. So what I have done is I have considered the BSE 500 universe for this study. The list of toxic stocks that you will see at the end of the session, they are all part of the BSE 500 index. I think there are 3 main reasons why a stock ends up giving poor returns over a 2 to 3 year period. First, stressed valuations. A high price to earnings multiple can make even the best stock an underperformer from a 2 to 3 year perspective. Think HUL or ITC or even L&T. These are great stocks, but they have all been underperformers for an extended period of time because an investor bought into them at extremely high valuations. I love legendary investor Howard Marks' quote on this. No asset class or investment has the birthright of a high return. An asset is only attractive if it's priced right. Therefore, for this study, I have taken a PE ratio cutoff of 40 times. If a stock has a trailing 12-month price to earnings ratio of more than 40 times, then it has one cross against its name. So that's condition number 1 for being a toxic stock. It should have a PE ratio of 40 times or more. A stock also satisfies the first condition of being a poisonous stock if its PE ratio is negative. Now this is possible only if the company is loss-making. And since loss-making companies are not a good sign, these stocks are strong candidates for being toxic. Condition number 2 is leveraged balance sheet. Some amount of debt on the balance sheet is good. However, debt becomes dangerous if it goes beyond a certain limit. And it is widely believed that a company should not have debt more than its equity. This therefore forms the second condition of our list of toxic stocks. If the latest debt to equity ratio on the company's balance sheet is more than 1, there will be a cross against the company's name. It satisfies one of the conditions of being a poisonous stock. Condition number 3 is the operations itself. I think for the stock to qualify as an investment, it should have a profitable operation. If the company is frequently loss-making, then there's some genuine issue with its fundamentals, or its fundamentals are not strong enough. Therefore, not a good idea to invest in such a stock unless the fundamentals are sorted. So this becomes condition number 3. If a company has 2 years of losses or more in the last 5 fully completed financial years, then it gets a cross against its name and satisfies the third condition of being a poisonous stock. So these are the 3 conditions that I look for in a stock when I'm trying to identify poisonous stocks over the next 2 to 3 years. Condition number 1 is valuations. Condition number 2 is debt to equity ratio. And condition number 3 is losses in at least 2 of the last 5 years. Now, I'm okay if a stock satisfies 1 or even 2 of these conditions. But if there's a cross against a company's name across all the 3 conditions, then it's a dangerous situation in my view. I think it's very difficult for a stock to give good returns over a 2 to 3 year horizon if its valuations are stretched, the debt to equity ratio is at a dangerous level, and it keeps on posting losses at regular intervals. It's a triple whammy, and such stocks should be avoided at all costs according to me. I'm fine if a fundamentally good stock is trading at expensive valuations, or if a company has debt on its balance sheet but is not trading expensive and also has profitable operations. Likewise, I'm also fine with a company where the debt is high but the operations are profitable and the valuations are cheap. However, what makes me negative towards the stock is all the 3 bad qualities present in one stock at the same time. Now, what this effectively means is that the stock is not only expensive, but the business quality is also suspect, and hence one should stay away from such stocks unless there is a marked improvement in the fundamentals or the valuations come down to more reasonable levels. So how many stocks are there where there is a big red flag across all the 3 conditions we just discussed? Which are the stocks that have expensive valuations, stretched balance sheet, and frequently loss-making operations all rolled into one? Well, here's the list of those stocks. There are 22 stocks in all, arranged in alphabetical order right from Adani Green Energy to Wokhard. Please note that this list does not include any banks or financial institutions because their business model are different in terms of debt and the way they are valued. Also, please note that this list is devoid of any personal bias whatsoever because it is based purely on numbers and does not have any subjective element. It is all objective, fact-based analysis of which stocks are likely to prove poisonous and which ones are not. Now, another point worth pondering is that investing in stocks is all about the future, whereas we are relying completely on past numbers here. What if a lot of these companies are genuine turnaround candidates and are potential multi-baggers in the making? Are we not making a mistake by not considering their growth prospects and ranking them based entirely on their historical financials? Well, my simple answer would be to consider the potential risks while making investments in such stocks. These stocks may have a great future, but it has not reflected in the performance so far, to be honest. What if the improvements in the performance take longer than expected or does not take place at all? Wouldn't the downside be huge in such a case? Please note that there is a risk in every stock we buy. There is no such thing as 100% risk-free stock. Therefore, as investors, it is our job to keep these risks to a bare minimum. However, I don't think our downside would be protected if things don't pan out as expected for these group of stocks. Besides, with the way the valuations and the fundamentals are placed for such stocks, the upside is also pretty limited in my view. So we are looking at a situation where while the upside is limited, the downside could be significant. Certainly not a good situation to be into. You see, I'd rather be diligent and unlucky than be reckless and lucky. Sooner or later, Lady Luck will start favoring a diligent investor, but if luck runs out for the reckless investor, it'll end up extracting a huge cost. So be diligent and stay away from poisonous stocks will be my message in this new year to you. Let me know what you think of this view. Please subscribe to the Equitymaster channel if you haven't already, and please keep the feedback coming as we really appreciate your comments. Goodbye and take care.